Can you hear me, Paul?
Yep.
Awesome. Well, folks, welcome to the latest Denny Artache show. Man, I've taken a break for personal and business reasons, but I'm back, and I think this is the greatest way to start it with my great friend Paul Meeks. Paul's he's a humble guy, but he's quite a smart dude. First of all, he loves rock and roll. Let's get that out of the way. He still pays money to see Bruce Springsteen and other classic rockers. And Paul, that's got to cost you a pretty penny, right?
Yeah. Thanks to Ticketmaster.
Yeah, I honestly, how much did you pay last time to see the boss?
300.
Oh, nosebleeds?
And I think I might have gotten out easily. Yeah,
Oh,
it wasn't there weren't bad seats. It was in Greensboro, North Carolina.
okay.
Yeah, I was there early in line, but yeah, 300 plus for each seat.
It's amazing, I guess they still love to play and the money they make. And I've heard, Billy Joel, a lot of people, some of the tickets are like $1,000,
Yeah.
and so much for inflation and people not having money. But listen, folks, again, Paul doesn't like to brag, but he's about a 33-year equity analyst and portfolio manager. His niche and forte and fame, because he is a rock star, was technology stocks. He ran the largest technology fund for Merrill Lynch. You remember back then, Paul, when you did that?
I do remember both the good times and the bad times. The good times
Exactly.
when the
Yes, we
internet
gotta talk.
bubble inflated, the bad times when it popped.
Yeah, you had more than egg on your face when it happened, right, brother?
Yeah, but then you also kind of learn through the experience because I was pretty young then, maybe even too young to have that job. But you learn for next time. And so one of the things I've done is I've always had ever since then a plan B because plan A tech stocks all the time definitely needs a plan B.
Yeah, exactly. That's right. And people don't realize that because you're a good friend of mine and you have the dividend model with independent solutions. I love our calls. We could stay on forever to talk about markets and things because you're just so smart. I want to tell people again a few of your accolades. Folks, besides being with Independent Solutions and the fund that he ran for Merrill Lynch, he teaches at the Citadel in Charleston. Paul, I got to tell you, I just don't know where you find the time. I don't know how you do it. So he teaches finance, accounting, and of course, with Independent Solutions, he's got his technology, he's got the dividend model, and a few things. And of course, Paul, he's on CNBC every week, folks. I think since the internet bubble and way back when things got crazy, they've always wanted Paul's opinion on things. So besides that, Paul, there's a few things I want to go over with you. Last time we spoke, you kind of casually said, I think we're going to be up a little bit of next year. And guess what? You're right, because the S&P is up about 6%.
Yep.
But it's interesting because the Dow itself is actually flat and was down, but yet technology is up, what, 19% in the NASDAQ 100? Did I see that correctly?
Yeah, that's about right. And it's because the NASDAQ 100 and the S&P 500, for that matter, are driven by, select few tech stocks, the mega cap names, the FANGs, as they're called on CNBC. And so those have had a particular big bounce. And so oversized impact positively this year, whereas they had an oversized impact negatively last year.
Yeah, and how about your favorite little old company called Apple? It's not looking too bad right about now, is it?
Yeah, I watched the webcast last night. It was mixed, but luckily Apple can pull some levers that other companies cannot. One of the nice things is over time they transitioned from a purely product company to now services are almost a quarter of their sales. And the nice thing about services is it has a super high profit margin, much higher profit margin than products like the Macs and the iPads and the iPhones. And so you think about it as services becomes a bigger part of the overall mix. It has a much higher profitability margin than the rest of the products. It's going to lift overall profitability with it. So even though the company grows at a pretty sluggish rate, they will probably continue to see profit margin expansion.
Sounds to me like they're catering to lazy people who just want them to do everything, service
Yeah.
instead of
Well,
the technology.
that's their shtick, right? They have an ecosystem. You buy the phone, and then you feel like, to maximize my role in the ecosystem, I got to have the Mac and the iPods, and maybe I should get Apple Music instead of Spotify. And so they bring them all into the club, and of course, that's exactly what they want. And over the years, they've built an installed base of about 2 billion users, right? So there are 2 billion people on planet Earth that have one of the devices. And so, of course, now that they have one of the devices, they try to pump them with other products and services.
Yeah, most people, including me, spend way too much time on their iPhones.
Sure.
My schedule's there, information. I can remember years ago, AT&T made so much money with that ad because the CEO was holding it saying, hey, all this at the palm of your hand. And here we are so many years later, and people can't be caught without it. So listen, let's talk about the Fed, because we both know that politics doesn't really dictate many things. The Fed does. And my goodness, I think he's officially scared, but he did raise it a quarter point.
Yep.
Do you think he's going to back off, or he's going to increase it going forward?
I think that was the last hike. So we had, just a day or so ago, quarter point. So now the Fed funds rate trades between 5.0 and 5.25%. That's about as high as it got the last time we ratcheted up rates back in 2007. But I think what happens is now they're going to stand pat. And what they need to do is see how these tweaks in rates, which have been fast and furious ever since March of 2022, are going to, with a lag, impact the economy, right? They don't want to get too far ahead and say, hey, we're not bringing down inflation. Well, of course you're not, because there's a lag. And so now I think they're going to see with a lag what the impact is on inflation. So I do think that was the last hike. I think the next time you see them move, it won't be this year. I think it'll be next year. Denny, I think we're going down. I think we're going to lower rates in 2004 and 2005. And so what had been a real stiff headwind with rates going up, I think becomes a nice tailwind as rates go down, not this year, but next year and the year after.
Well, I think the market is pricing that in, yes, that they expect rates will come down next year and the year after that.
Yep.
But, it's so interesting. I mean, you look at, I think the job figures came out better than they expected.
Yeah.
And for some reason that affected bond yields, did it not?
Yeah. Because you think about it, services is such a big part of the inflation calculation. And then buried within that is wages. And as long as the U.S. job market stays tight, and it is tight as a drum, you're going to have continued pressure on wages. And that's going to be really difficult because we really don't solve this inflation conundrum until we start to see wages slack a bit. And unfortunately, I never want to see anybody get fired. Right. But we're going to have to see some weakness in the job market. And today's print showed it was even stronger than people thought. So unfortunately, if you're a Fed watcher, going in the wrong direction.
Well, it's so weird how things go opposite. That yes, unemployment is actually better for inflation, which would be better for us. But then people have less money to spend. And I never got the whole thing that people spending frivolously and jacking up credit is good for the economy, which brings me to my next question. I think GDP itself has actually slowed down. So we're a lot closer to the recession fear that they had, let's say, a year ago, aren't we? That's the truth right now.
Yeah, the GDP rate in the fourth quarter of last year was 2% plus. And in the quarter just announced, it was barely 1%. So I think the U.S. economy this year, does not enter a recession. I think that's a next year deal, but it's going to grow very slow, 1%-ish. Do think we have a recession next year, but I think everybody knows that, foregone conclusion. I also think it's going to be pretty short and shallow. And so that's why, Denny, stocks are up this year, even though recession is on everybody's tongue. Because yes, I see it. It's coming, no doubt, but short and shallow. So let's look on the other side. So that's what's happening now.
And that's the difference. They are expecting a short recession,
Right.
not a long one like we had previously.
Right.
So,
Or particularly deep.
Or particularly deep. Yes, correct. I hate to say it, but I think political and world issues will affect the market. I think it'll change sentiment.
Yep.
Because the simple fact is, because the rates are where they are and they will remain in the next 6 to 12 months, there are a lot of attractive yields out there without much risk. However, I would think that equity investors for the next 5 years, if we have a next sell-off, that would be a great time to step in.
Yeah, because I believe that the next move of the Fed is not rates going up, it's rates going down. And so the next time we have a drop, and we will, right? We'll have many drops between now and the end of this calendar year. I do think if it's significant enough, good buying opportunity.
I don't mean to interrupt you, but I think it'll be something irrelevant, for lack of other words, like a world or global event or something to that matter. But yes.
Well, the key trigger could be, because it's my greatest fear now. I no longer see the Fed raising rates as a fear. I put that rear view mirror. However, this debt ceiling.
Yes.
Right. We have to solve that riddle. Some people say as soon as June, and other people say we might have some breathing room until August. But whether it's June or August, that's coming up quick. And that could be a factor, Denny, that you're talking about, this exogenous variable that causes a downdraft. Because the last time we played this fool's game was back in 2011. And at the final hour, right, Congress and the administration came together.
Like always.
They waited to the final minute. And just the anxiety around that back in 2011 did cause the S&P 500 to drop 17%. Now, once they solved the problem, the market came back pretty quickly. But I think that is our next biggest risk. And if it does cause a bloodbath in the market, then it's probably time to buy with both hands.
And that's the difference, Paul. I think people that are drawing income currently and are already retired, that's a different time horizon for, say, the investor that's investing for the next 10, 15 years. And that's the difference. Yes, of course, the stock market doesn't go straight up or straight down. It has many bumps in the road, and you have to be able to weather the storms. And that's why you came up with your dividend model, right? You had the momentum model you were doing for a while.
Yeah.
So what do you think from now until the end of the year? You think we'll stay where we are, we go up, or we take a breather?
I actually think that there's short-term risk around the debt ceiling debacle.
Okay.
So elevated risk through the end of the summer, right? I don't know if it becomes a June phenomenon or an August phenomenon, but it's going down before school starts in the fall.
Which is a great time to buy, Paul.
Right.
That's what we're discussing here.
But once we get through that, I think that the market rallies. Why? Because we might even have a recession then, Denny. If we don't, it's going to be imminent, but it's going to be no surprise. People are going to come to the conclusion, like me, I believe, short and shallow. And then they're also going to start thinking about the rate cuts next year. And if we do have rate cuts next year, the market forecasts that about 6 to 9 months in advance. And so if that's going to happen, that's going to be a nice tailwind at our backs. I think you want to be in before it. So anyway, you think about it before we get to the end of this year, December 31st, I bet we have a market rally after we have a potential dip around the debt ceiling thing.
Yeah, well, I think investor sentiment can change. I mean, look, the regional bank issue, which scared the bejeebies.
And I thought that was contained, a couple of weeks ago, but unfortunately, now you have Pacific West, and then you had First Republic, go down on Monday. So unfortunately, that continues to drip. I do think it's a community and regional bank only issue right? You're not going to have a problem with Bank of America, or Wells Fargo, or Citi, or JP Morgan. But unfortunately, that continues to be a risk. And I thought that was going to be cleared up a couple of weeks ago. Not so fast.
And again, this will dictate the average American about seriously considering putting all their money with banks like that. It's just, again,
but there's like anything in life, there's a good thing, bad thing.
Yes.
About that. The bad thing is, wow, banking crisis. The good thing is, because the other banks don't want to be in that bad club, they're going to tighten their lending, right? They're going to be more careful with their lending. And that in and of itself, that protective step is going to slow down the economy. And that is also going to help the Fed not have to raise rates again, and also dampen inflation. So that's
right.
As long as it doesn't boil over into a full-fledged banking crisis like '08, that is the positive of what's going on with the banks right now. It's going to, in and itself, going to act like another interest rate hike, so the Fed won't have to do it.
Well, certainly it's going to affect many things. Like I think that's what's affected home ownership and sales in real estate, of course, because I think it's off by 35% year to date, something like that. A big difference in rates, but as things cool off, as you say, yes, with a slowing GDP and inflation being in check,
I do think we'll, with a lag, get some weakness in the job market, which is actually a positive.
I know, I hate to say it.
I hate to say it, right? Because, we're good guys. We don't want to see anybody lose their job.
Right, yeah.
But there have been a real bloodletting in Silicon Valley. And some of those, tech firings in the tens of thousands, so far they haven't showed up in the numbers, but they're coming, right? Because the firing announcements have been made. People have been leaving the building. So those numbers, not yet in the stats, they'll be in the stats before too long.
Well, are there certain sectors or companies that you like going forward because of what's going on in the market and global events and the economy in general?
I would say a couple things. But first, the asset class, before we delve into the economic sector. You and I have talked about this before, a generational opportunity to buy fixed income. So for my clients that are either in my dividend model and have cash, or my private wealth group model and have surplus cash, I take the surplus cash and I put it in short-term fixed income. Right now, the yield on a super safe U.S. Treasury that matures in only 4 months is like 5.1%.
I know. I know. Did you?
So the way I look at it, 5
years ago, if you would have said that, someone would have asked you to pee in the cup or take a drug test.
Right. So in the meantime, whether it's a money market mutual fund, whether it's a mutual fund or an ETF that buys short-term treasuries, whether you have a big enough portfolio so you can buy individual treasury securities, which usually is inappropriate unless the portfolio is large. Man, it's a really good opportunity. And you could not say that as recently as 6 months ago, much less a year ago. And so that is, for conservative investors, my best bet, believe it or not. And you're talking about a guy that usually invests in aggressive tech stocks.
Correct. Swing for the fences.
Right. So with equities, I still think it pays to be cautious, at least until we get through this debt ceiling debacle. And so I am pretty heavy in consumer staples and industrials, some basic materials, maybe even some energy and utility stocks, still in the bunker or maybe creeping out of the bunker. I'm not ready to go too aggressive with tech. And even in my tech model, I try to play defensive tech. My tech model has very few of the fangs. The fangs is what everybody has. I have a couple of the fangs. We can talk about them. But I have a lot more smaller and mid-cap stocks because I think it's a more defensive way to play tech, because some of these fangs, since their big bounce last fall, are trading at some egregious values, including Apple.
Well, that brings me to another question that I forgot to ask. There's also a lot of why we may have a sell-off is they think the market's expensive right now. It's trading a little bit higher than acceptable PE ratios. Do you agree with that?
Yeah. So right now the S&P on a forward basis is trading at about 18 times.
Okay.
Over time, the average is maybe 15 to 16 times. And the problem is this. It's okay to have a high multiple, but usually when you have a high multiple, the interest rates are low and earnings are growing strongly. Earnings are growing for the S&P in this kind of valuation in the mid-teens percentage. But the problem is we got the high valuation, not egregiously high, but definitely over the average. And
Okay.
unfortunately, we don't have the low rates. We got higher rates. And this year, the earnings on the S&P 500 will not be up mid-teens percentage. They might be down 5 to 10%. So we kind of have a mismatch right now, which has me worried short-term about the markets. Interest rates up, earnings coming down, and that is not a recipe to have a high S&P multiple. It's actually the 180 degree from the recipe. So that has me short-term worried. Not long-term worried, short-term worried.
Yeah, if profits suffer, so will the stock price, plain and simple.
Yeah.
Well, that's interesting. Okay, well, are there any sectors you think do not look attractive going forward for investors because of
Yeah.
what's going on?
At the beginning of the podcast, you talked about tech. So here we are in May of 2023. The Dow is flat to slightly down. The S&P 500 is up about 5%, and the NASDAQ is up double digits. Now, part of it is a bounce because, the NASDAQ was down, the typical tech stock was down almost 40% last year. So you could say it's the stocks got oversold, but unfortunately, Denny, I think they're now overbought. Too big of a bounce, too fast. I've been listening to all these tech conference calls, including Apple last night. They're not telling, really rosy stories. There really is no turn in fundamentals yet. So anyway, sectors that I worry about, I actually think we're going to have some comeuppance in tech. Too
Have
far,
they
too
mentioned
fast.
that? Have they mentioned that their sales are off or their profitability is off?
The problem is tech companies definitely need to have top line sales growth. And what they've been doing this earnings reporting season, which I don't give them full credit for, is their revenues are still weak. Like Apple, for example, shrank year to year when they reported results last night. But their EPS, earnings per share, is either flat or growing because they do a couple of things. They fire some people, they lower their costs. In Apple's case, they actually bought back so many shares that they lowered their share count and they boosted their earnings per share by doing that. So I don't give these companies too much credit for these games because at the end of the day, if you're tech, you grow your sales or you don't. You can't get to the dance by just cutting costs. And so I think they've gotten a lift by cutting costs, but I think that exhausts itself. So I look for tech companies that are hard to find that despite this debacle are still continuing to grow their sales at a nice rate.
Interesting. Well, certainly appreciate folks if you're listening. Independent Solutions, we could discuss for a long time the many different ways that they're different from everyone else. And Paul, the private wealth group has been doing very well because you're able to do different things there. Is there
Yeah.
anything new that the private wealth group is focusing on in the next 6 to 12 months?
Yeah, we've brought on some folks to supplement things. I think the magic with the private wealth group, and I've been doing this since the 1980s, is that with the private wealth group, a financial advisor and his or her prospect, and definitely his or her client, can talk to a portfolio manager. Kind of rare, right? When I
Right.
was at Merrill, I managed much more money. I managed $8 billion, but I managed mutual funds, and not because I'm not a nice person. I think I am a nice person, and I'm pretty extroverted. But I would never never would talk to a client for sure. Never would talk to a prospect for sure, and would even super, super rarely even talk to a financial advisor. So that's one of the cool things where you get to talk to, like, call up somebody and say, hey, Paul, what do you think about the debt ceiling? You would never be able to do that at other shops. And so anyway, I think that's actually the secret sauce, right? You get to talk to the dude. When I say dude, man or woman,
That's right.
actually managing the dough. It's actually quite unique.
Well, I know my clients certainly enjoy it. I enjoy it, and that's absolutely true. You won't get it anywhere else, no matter how many assets you have under management with them. And that's a beautiful thing with independent solutions. Hey, we had a great time just recently in Jupiter. I
Yes.
mean, everyone came from around the world, the country, and whew, we got
Yeah,
about what, 3 4 hours
I
sleep.
enjoyed that conference, and even though I'm not a financial advisor, I listen to all the presentations, and like anybody else, try to have a couple takeaways. And yeah, I thought there was some good stuff, and the people are cool. And I snuck away. One time I did a CNBC spot from my hotel room, and then I snuck away, and I actually had to listen to a couple quarterly calls because we're right in the middle, as we were last week, of
Sure.
this quarterly reporting season. But yeah, made time for that. It all worked out.
Paul, always a pleasure, my friend. I guess we should do this every quarter.
Yes.
And so far, you've been your batting average is very well, my friend. And
Thank you.
as always, I learned so much talking with you, and I always enjoy it. So don't be a stranger, and let's get
All
together
right.
soon, okay?
All right. Be well.
All right, Paul Meeks, ladies and gentlemen, thanks for listening to the latest Denny Artache Show podcast. I'm back. I'm back. Maybe some of you want me to stay on vacation, but I'm back. Paul, thanks a lot.
All right. See you, fellas.